Okay.
Good morning, everyone. I'd like to call the Finance Auditing Committee meeting of September 26, 2024. And if we could have a roll call, please.
All right, thank you. Director Dorsey, Sampson, Giudice,
Here.
Grosboll,
Here.
Hernandez, Sampson, Winston,
Here.
Rodoni,
Here.
Vice Chair Park, Sampson, Chair Rabbit,
Here.
President Cochran.
Here.
Thank you. You have a quorum and you are a committee of the whole. In the room, we have Directors Hill, Snyder, Cherio, and Thier, and Garbarino rounding us out.
Great. Well, great. We'll move on then to item number 3, which is the ratification of previous actions by the auditor controller. Those are on pages 5 to 26. The PFM report starts on page 9. And look to my colleagues if there's any questions, comments, concerns on that. We do have Michael Kronbetter here from PFM. Michael, welcome.
Thank you. Thank you for having me.
You got a sneak peek at the ferries too, if you
I missed the comment, sorry.
Oh, I said you got a sneak peek at the new ferry, so it's worth coming for.
Oh, yeah, well, you'll have to direct me to it after the meeting. I didn't see that.
Okay.
Appreciate you letting me know, yeah. Well, if you're turning the floor to my microphone, I appreciate the opportunity to come and speak with the committee today. And just as a starting point, I think it would be remiss if I didn't talk about last week's Fed decision with the interest rates. So we'll lead with that. And just to let you know, we're aware of it. The Fed reduced 50 basis points. That was a surprise to the market, generally speaking, in the month leading up to that decision, although as it came down to the wire, that there was more nuance that the market was aware there would be likely a 50 basis point move. But in the end, it was somewhat of a surprise. So of course, the market reacted with that. The market typically sets yields up in an expectation of where they expect the Fed to be with interest rates on the overnight borrowing rate. And so that had an impact. They also set expectations for the remainder of the year that 2 additional rate cuts would be coming. So a total of 4 rate cuts by the end of 2024. And likewise, they set expectations for next year, 2025, for the same number of rate cuts. So over the next, year and a quarter, we're looking at a total of 8 quarter point reductions in interest rates at a quarter point each. So it's pretty remarkable when you look at June 30th to now what the 2-year Treasury has done. 120 basis point decline in the 2-year Treasury rate if you're looking at page 10 of your report. I think that's worth noting as well. When rates come down, it's a great thing for positions in the portfolio because market values on securities and fixed income rise as yields come down. So it's supporting a positive return on the market values in the portfolio in that time. And again, that continued through September leading up to the Fed meeting. So if we turn to page 11 to look at why the Fed did a 50 basis point reduction and why they're now, after a year of talking about this Fed pivot, they're finally pivoting to lower interest rates. It's because they feel more confident in the decrease of inflation, that inflation is now under control and approaching its 2% mandate year over year on an annualized basis. And as you look at CPI, the headline CPI number at 2.5% is certainly on that trajectory. There was a pause in the first quarter of this year as that progress, the Fed didn't feel progress was being made on inflation, but that has since resumed, and they feel confident enough to have jumped ahead with 50 basis points on that decision. Wages are still outpacing inflation as you look at wages and the health of the consumer. Retail sales numbers came in positive for the month. So overall, the consumer is leading economic growth, which is projected by the Fed to be 2% by year end, slightly lower than what we saw in the first half, but still a healthy pace of the economic growth. Unemployment rate, we're at 4.2%. That is expecting by year end based on their economic projections last week that were released, 4.4%. Still healthy by historical standards over the last 50 years. We're looking at a range of 5.5% to 6%. So we're still well under that, even if we do approach that 4.4% by year end. But there has been trends lower with non-farm payroll numbers month over month. Those have been declining last 3 months, averaging about 116,000 new jobs per month versus the prior period, over 200,000 jobs per month. So that's a noticeable decline. In fact, they even changed their language from moderating to slowing in the progress of job growth. So that's a big deal in Fed speak when they change a nuance of their wording. Looking to page 13, job openings versus unemployed workers. We're approaching a 1-to-1 ratio right now. There's 1.07 jobs for every known unemployed individual seeking employment. That's down from a very slack market of 2 jobs for every 1. And that's a good thing, as it puts less pressure on inflation because wages are being held in check in that way. Skipping to page 14, kind of what we had seen for the predominance of the last couple of years with an inverted yield curve across the curve is now actually reverted to a normal yield curve when you look at historical yield curve from a 2 to a 10-year. So the 2-year yield is under the 10-year yield, more traditional, and what we would expect from investing longer term. You want higher yields, but that hasn't been the case for the past 2 years. It's called an inverted yield curve. Having said that, the front end of the curve from 0 to 5 years remains at that inversion because short-term rates are tied more closely to the federal funds rate, to the Fed overnight benchmark rate. So as they bring that rate down, it's expected the yield curve to continue to normalize. We have a slide in here with the S&P 500 just showing growth for the year. Of course, lower rates are often correlated with higher returns in the market as borrowing rates go down, and it stimulates growth. Looking at page 16, just a portfolio update. I just want to reiterate, coming here today, that the portfolio is managed in compliance with California code. I mean, very conservative. We're aware and have been of the changing economic environment to a moderation and perhaps slowing, and that the Fed would be reducing interest rates, or we're likely to be reducing interest rates. And with that, we were trying to strategically capture interest rates at the time they were high to favor the portfolio. There's a summary of transactions here in the report. The next page, slide 17, I did cover the economic outlook, where we have a 50 basis point cut now. That doesn't mean 50 more at each meeting. It's just a quarter is the expectation set for the markets in additional reductions at upcoming meetings. I'll end with the fact that the Fed did use the term they're recalibrating, not necessarily pivoting. Recalibrating is a safe term to say that the economy it is still a healthy economy, but they're just adjusting interest rates at a pace that they feel comfortable that won't overstimulate inflation again and not hurt the labor market. So they want to maintain their dual mandate of steady prices and maximum improvement. I'll pause there. And again, just reiterate the portfolio we manage. We are grateful for the relationship. It remains highly diversified per code, and we reflect that on page 18.
Great. Thank you very much, Michael. Appreciate you again being here, and appreciate the presentation. I'm looking to my colleagues for any questions, comments, or concerns. Seeing none, just want to say again, thank you, especially in these different financial times, staying on top of things, and very much appreciate the returns for the district. So thank you.
We appreciate your responsibility. Thank you.
Is there any public comment on the item number 3, which 3A through D?
No public comment.
All right, I'll look for a motion to ratify the previous actions by the auditor controller from my colleagues.
So moved. Second.
We have a motion and a second. And with that, can we do a voice vote?
Voice vote, fine.
We'll do a voice vote. All those in favor, please say aye.
Aye.
Is there anyone opposed? Please say no. Hearing no opposition, that does pass unanimously with all present. Thank you very much. Thank you again, Michael.
Thank you.
Moving on, there are no authorized budget adjustments and/or transfers, nor are there any authorized actions related to the grant program. So we'll move on to item number 6, which is the approve the actions relative to the funding plan for the Golden Gate Suspension Bridge Seismic Retrofit Construction Project. And John Eberly, District Engineer, is here to discuss this particular item. Thank you, John. This is on pages 27 to 30.
All right, good morning. Good morning, Chair Rabbit, members of the committee. So the staff report this morning recommends that Finance-Auditing Committee recommend that the Board of Directors authorize the following action relative to the funding plan for Golden Gate Suspension Bridge Seismic Retrofit Project. Number 1 is to approve a funding plan for the project 2250 Golden Gate Suspension Bridge Seismic Retrofit Construction Project in the amount of $869.6 million. That would be funded with $400 million from the Federal Bridge Investment Program grant funds, $200 million in California Department of Transportation Local Highway Bridge Program funds, and $269.6 million Golden Gate Bridge Highway and Transportation District reserves. Also to authorize the general manager to sign the Bridge Investment Program grant funds designated subrecipient agreement with Caltrans and any future agreement amendments, and also to authorize the general manager to sign the Caltrans HBP fund high cost agreement with Caltrans and any future agreement amendments. So this project is the final phase of the district's program to retrofit the bridge. And this project is the district's largest undertaking since the original construction of the bridge. The general scope of the work is listed in the report and was also presented back in May to the Building and Operating Committee in the engineer's report. The project is currently included in the current fiscal year capital improvement project budget at $870 million. And it's a very, very large project. The district has been pursuing grant funds. They'll pay for the construction. And in 2023, the district was fortunate enough to receive $400 million in the federal BIP investment program funds. The district also recently received a commitment from Caltrans, the state, for an additional $149 million in state funding for the project, bringing the state share up to $200 million. In order to fully fund the project and to receive that $400 million from the federal BIP fund, the district is committing in this funding plan to $269.6 million from district reserves. The $400 million in BIP funds will be distributed to Caltrans as a recipient. This will be an agreement with Federal Highway Administration. So the district must execute an agreement with Caltrans as a subrecipient to receive those funds. And in addition, Caltrans will then pass on the reporting and other requirements that FHWA require to the district. So that's what that agreement would be. And similarly, the district will be executing a high cost agreement with Caltrans in order to receive the disbursements of the HBP funds. So with that, staff is recommending that the Finance Committee recommend that the Board of Directors approve the funding plan as shown in the report, and also authorize the General Manager to sign the BIP Program Grant Fund designated subrecipient agreement with Caltrans and any future amendments, and also authorize the General Manager to sign the Caltrans high cost agreement. And with that, I'm happy to answer any questions the committee may have.
Thank you, John. Appreciate that. I am going to go to the general manager, and then we'll have a discussion regarding this small little item that we're taking up this morning.
Thank you.
I just want to acknowledge a couple of things. First, a year and a half ago, we received a $400 million discretionary federal grant. And so it's important again to say thank you, Speaker Emerita Pelosi. The Bridge District for many years has advocated in Washington, D.C. for various programs and concepts. That program did not exist, 4 years ago. The bipartisan infrastructure law included a new bridge program that had not existed at the federal level since 2012. That included a discretionary component, and it included a really big bridge discretionary component, all things we advocated for. So I want to thank all the board members that assisted in that advocacy over all those years before we achieved that outcome. I'd also like to acknowledge Paul Schlesinger, our Washington, D.C. lobbyist, as well as Speaker Emerita Pelosi. So a new program was created. We competed. I'd like to acknowledge all the staff at the district, current and former, who worked informing the Federal Department of Transportation officials that their benefit cost analysis process was flawed and discriminated against protection against extreme events. Because without the effort of a whole host of folks in engineering and finance and grants, we would not have been successful in that initial grant. Fast forward, we've been talking to the state for quite some time about, upping their contribution. We had $51 million from the Caltrans Local Highway Bridge Program that's been sitting out there for some time, left over from another project that came in under cost. So we needed to have some time pressure, it appears, to finally get that to fruition. We have a time pressure. The $400 million was going to go away if we didn't finalize the funding plan pretty quickly. So we worked very aggressively. I want to thank the Newsom administration, the governor himself. This is a very difficult time for the state budget. You all know various programs at a local level that got less money from the state than you did historically. As part of the budget process, there's a lot of pressure to see if they can retain general funded programs by transferring the cost to other programs. So things like active transportation that were funded by general fund a couple of years ago, this year being funded from the state highway account. So the state highway account got rated, so to get more money from the state highway account for what we wanted was very, very difficult and challenging. We had lots of people who weighed in on our behalf, and so I'll just mention a few of them because we want to thank them. I want to thank Senate Pro Tem Mike McGuire. He weighed in, and he weighed in big. He tried to help us several different ways, and he was instrumental in making this happen. But a lot of other folks weighed in at various junctures with the administration on our behalf. It's one thing if I go up and talk to folks in Sacramento with our, Steve Wallach and Bo Biller, or a couple of you come with me, but have other entities that's very helpful. So Transportation California weighed in on our behalf. The California Alliance for Jobs weighed in on our behalf. Jim Wunderman is the head of the Bay Area Council of Big Business Group, one of the biggest influencers in Sacramento. He weighed in on our behalf. And CTC Commissioner Jay Bradshaw weighed in on our behalf. I think the Carpenters were the largest contributor to the anti-recall campaign, so that's probably a good organization to have weigh in. He's the head of the Carpenters Union for Northern California. So we had a lot of people that weighed in on our behalf, but the item before you has assigning lots of things. It has $149 million of new money coming to us. We had 51 million before, so they're going to give us 49 million from the Caltrans Local Highway Bridge Program. So that 100 million from the Caltrans Local Highway Bridge Program we spread out over 5 years, 20 million a year. The exact years will be worked out when we sign these agreements. Then they're giving us $100 million of additional new money from the state highway account. They're going to run that money through the local bridge program. They did pick up on some suggestions we made on ways they could make this happen, and that'll be 100 million will be spread over 2 years. So it's a huge achievement for the district. We ideally wanted to get more money from other people and have only a 20% district match. This works out to be a 31% district match. Any future cost increases or other challenges we have, we won't be talking about a match. We'll be talking about how we need help from others so that we don't have to cut bus and ferry service to free up money. And then once again, I need to make a big pitch for your reserves. You set aside money every year out of your operating budget for capital reserves. You save up money so when we have a need like this or a new ferry boat, particularly like this, that we have funds available. So my hat's off to the board. Prior boards, 25 years ago, we did not have capital reserves. My hat's off to prior boards, to our CFO, Mr. Joe Wire, because we have a reserve structure that allows us to navigate, having lots of really, really old stuff that we're responsible for. So I just wanted to get some thanks out there. It's a huge deal, and it's $149 million of new money when money is tight at the state level. So staff strongly encourages you to vote in the affirmative for this item.
Appreciate that very much, and do want to go to my colleagues. First, I'm going to go to Director Terrio.
Not at all to force call discussion on this, but I'm going to move approval of the recommendation.
Appreciate that very much. Thank you. Director Giudice?
Yeah, I'm happy to second that, but I just have a question. So does this prevent us from taking on any new money?
No, the state was very clear.
Okay,
The conversation with the governor's staff was, this is the best they could do at this time.
got it.
That's a quote. And so they clearly left the door open. They know we wanted more. They know this put pressure on our bus and ferry system. I spoke with board president before, confirming with them that we would be recommending it. But that puts pressure on our system, in that they were very clear that it was at this time.
Thank you.
Anyone else have anything? Director Roswell.
I know this is a funding decision, but I'm just curious, and I'm not holding you to it. What's the estimated time frame for this project?
I think John and his staff are in negotiations. They will be over the next few months about the final cost and schedule for the project. I think they've finalized some quantities and stuff. They're looking at how they'll access it. They're going through all the detailed analysis. So I don't think you have a firm number at this time.
We don't have a firm number or firm date. We were always anticipating finishing the design in the first part of the CMGC process mid 2025 and going to construction 2025. So that's still our time.
But in terms of if it's a 5-year or 7-year construction contract, that's what needs to be worked out. But the start is still holding.
Anyone else? I want to echo the thanks that Dennis had. I know that I get questions sometimes, not through this district, but other hats that I wear on advocacy. And then I point to those occasions where advocacy pays off big time. And this district has been the beneficiary, I believe, over the years, and many different circumstances where that does pay off. I hope our lobbyists aren't listening, because they probably will increase their costs to us. But and I also think that it's because it's the Golden Gate Bridge is part of that, but it's also an upstream investment for the Bay Area and the state. And I think that's why Mr. Wunderman totally understands. As you all know, I mean, building codes, and I can say this as the chair of the State Seismic Safety Commission, building codes are sometimes set to just, I wouldn't say necessarily minimum standards, but not necessarily going to keep things up and running. And certainly a bridge that is as old, even though as well engineered as this bridge is, we undoubtedly, a strong earthquake, we would have some serious issues that we'd have to address, and it could block traffic. And of course, in the Bay Area and California these days, it's we know we're going to have that earthquake, and it's really how we deal with it afterwards and recover and get our economy back up and going. And if we're shut down for any period of time, we can easily, as the largest economy or one of the larger economies, even in the world, or let alone certainly in the United States, could have a detrimental effect. So these upstream investments, they are smart business moves, and they're smart for the safety of the entire community going forward. So very much appreciate that. And with that, we do have a motion, and we have a second. You have those down?
Yep.
I will ask if there's any public comment on this particular item.
We have no public comment on this item.
So there's 3 asks in front of us per the agenda, and I think there was spoken about the 869.6 million with the different assortment of funds, the authorizing the general manager, the grant funds subrecipient with Caltrans, and with the funds high cost, or the cost agreement Caltrans required to access the highway bridge project funds for the project. With that, what do we do? Well, we'll do a voice vote. All those in favor, please say aye.
Aye.
Is there anyone opposed? Please say no. Hearing no opposition, that does pass unanimously. Again, thank you all very much. Thank you, John, for your work. We know we're just beginning. Moving on to item 7, authorize change order number 5 to contract number 2019-D-002, security guard services for the bus and ferry facilities. And Kelly Hopper is here to give us a brief presentation. There's items on pages 31 and 32. Kelly?
This isn't near as interesting as
Yeah, I
the
was gonna
previous
say,
item,
from-
but at least pretend you're interested in what I have to say. Please. We're actually here just to talk about needing a change order for our security guard services. Right now, with the exception of the bridge, we have contracted services through Barbieri to provide on-site security for all of our transit centers. And that's there's about 6 different locations, as well as providing some onboard security services as needed for some of our special events on the ferry, such as Warriors, Giants, or any of the concerts. We are at the end of that contract term, and rather than going back out immediately, we are doing an assessment of our security needs. As you can imagine, over the last several years, security needs have morphed. And so we're trying to do a comprehensive assessment of what is needed moving forward. So as a result, we're asking for this committee and the board to approve a change order to the tune of about 1.4 million to give us that year to do the assessment and do a more comprehensive rollout of another RFP. And I'm available to answer any questions.
Great, thank you, Kelly. Director Maston.
And just a quick question. So at Santa Rosa, how often are they on site?
Oh, I was hoping none of you would ask me.
And the principal areas that we use them are San Rafael.
Yes.
San Rafael's our biggest bus yard. There's been lots of bus instances with bus operators in the recent years, recent week. And so we have a big presence there and a big presence at the transit center. We have a presence also in San Francisco. The Santa Rosa presence is less, just based on, the usage of the facility.
The only reason I ask is I always see a few cars parked there, but I never see anybody, and the building is open like a half hour twice a day or something. So I was just curious. Okay, thank you.
Sorry.
Any other questions for Kelly? I will look for a motion.
So moved.
Second.
We have a motion in a second. I'll ask if there's any public comment on this particular item.
We have no public comment on this item.
And with that, a voice vote to approve the change order number 5 for security guard services for the bus and ferry facilities. All those in favor, please say aye.
Aye.
Is there anyone opposed? Please say no. Hearing no opposition, that does pass unanimously. You're all present. Thank you.
Thank you.
Thank you, Kelly. Moving on to item number 8, receive the updated 5- and 10-year financial projection. Joe?
Yes, thank you to the committee and the board. We are here to talk about the projection. This is one of the primary legs of our financial planning process here at the district. We do a projection every year. And that's essentially the important thing to know about the projection is it's based on the budget that you just approved. So using that as your baseline, that approved budget from June. And then we look out 5 and 10 years from that with the idea that we don't make any decisions. We don't change anything. We keep doing the same things we're doing. But of course, the world around us is changing. And so what happens to us? And basically, it's a call to action. It says, well, that's not going to work. So we're going to be working together over the next 10 years to make sure that what you see in this projection never comes true. And that's what it is every year. It's essentially a call to action. And it's to let you know that sometimes we have to work a little harder. Sometimes things are a little bit easier. In other words, sometimes like last year, our financial deficit was much larger. We'll get to that than it is this year. Well, one of the actions that you took over the last year was the 5-year fare toll increase. And that makes a significant difference in your financial outlook. So it is a status quo, current services type operation. You're just telling you you're just going to do what you're doing. And that's something to keep in mind. It's not what you intend to do. This is not the policy that you will make. It's what you have already made. And a very good example is this committee just considered the item that came 2 items before this, where that item potentially, if additional revenues aren't found, that item would commit another $100 million in the district's reserve. Well, of course, that would change this item quite a bit. This item only assumes things that have already happened to do that. So let's take a look at page 35 on the graph. Before we start talking about the findings, we'll talk a little bit about the finances of the district. As the PFM representative Michael just told you earlier, that the district has significant financial reserves right now. It does. Those set aside for capital are in that table in the bottom, that graph, the 339. That was what we put in the budget this last year. Your reserve was slightly larger than that, but there are reserves for other things besides capital projects. And then those lines represent how that under our current process, how those funds would be allocated. That's the middle line, the dark red one if you have a color, black and white if it's the middle line. And that's how it's allocated. So essentially, you're going to allocate most of it in the next year, and that's because of what we talked about with the seismic retrofit project. That would be allocating a great deal of your reserves
But there are other projects in your capital plan too that you'd be allocating. And then the top line, the blue line, if you have color, represents the way it spends out. You can see it spends out much, much slower. You can allocate a lot of money to a large project, but it's not going to spend. It's going to take years, as I think we were discussing with that large project. And then the very bottom line is when we've added this year, and it's because, of course, this board just looked at an item 2 items ago that said you might commit another 100 million. And if you did, of course, that would lower that red line at the bottom, the allocation line, because even more money would be allocated. Now, there are ways that we work, and we say it every year during the budget and now, is that we keep moving these lines to the right so that they don't cross the 0 line. And the way we do that is we balance the operating budget and we bring in the capital contribution amount, which is approximately 21 million a year right now. We bring that in, we put that in reserves. And of course, we go out and we find grant funds to help fund these projects. So those 2 things are necessary. They will continue to be necessary. And the key to it all is balancing that operating budget, which, as you know, in the last couple of years, we've not been able to do without the help of others. But we are obviously, as a group, going to work to make that happen in the coming years. So now if we take a look at the next page for the findings, there's a little simple table in the middle, and we'll look at the bold lines below it. This essentially, the first number on the left, and then there's a number on the right. The first number on the left is the 5-year, and the right is the 10-year deficit. Those are deficits. The total, the top bold line says total operating capital surplus, 236 million over 5 years. And that's based off your 24-25 approved budget. It is different than last time. It was about 450 or 60 last time. So, last year, because we made significant changes. The line below that we added, which is another one that we don't typically have, but we put it in this year because it made sense. It's taking a look at your deficit if you base it on the expenditures that you're reporting right now. Now, you didn't add any more back. You didn't spend any more of the money that you put into your budget. And that lowers your 5-year deficit down to about 86 million. That's essentially saying what I'm doing today, I'm going to continue doing. And so it's a very true sort of current services level operation. You can see that number a year ago was 220 million. So that 86 number would be compared more to a $220 million number. So the district is significantly in a better shape. Part of it is continuing to hold on to its expense levels. That's really important. The other part, of course, is it changed the toll structure that you made. That's the other big part. Going forward, we won't be changing the toll structure as we did every year. We do still have the ability to hold on to our expenses and, of course, to work on other revenues as we go forward. So if I can take a look on the last thing I wanted to talk about on this report is on page 38. And it's something we've always had in this report. And basically, the report assumes that we're going to get about 80% grant funding for projects. And of course, that it doesn't always come to pass. And as Dennis had mentioned, if we end up spending all of the monies that we talked about in that item 2 items ago, that would lower the percentage funded for that particular project to around 70%. And that's very good, obviously, but not what we had planned. So if that were to happen, that's the middle line on that table, grant funding at a 70% level, that would add about $100 million, $98 million to deficit. There's no surprise there. Why is that number? Because that's about what we'd be committing to the project. So those numbers that you saw earlier that we talked about in the findings, they go up by 98 million if in fact this is the way it plays out. Just knowing the length of a project, and we've discussed this amongst your staff and everybody else multiple times, is that this project is going to take many, 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 many years to spend out. And during that time, the district has the opportunity to continue to look, and obviously the commitment from many of you to do that, to continue to look for resources to avoid that kind of pressure that it puts on the rest of our operation, which is primarily transit, to do that. The report has a number of appendices. We will not go into them, but they have details on how we've come up with these numbers, the assumptions, or anything else. So if there's any questions now or next month or another time on this particular report, please feel free to just contact me.
Thank you, Joe. I appreciate all the work. Looking to my colleagues, it seems to me fiscal years are our friends in terms of the replenishment that we can go forward, obviously, but that also could be your enemy in terms of thinking again about how the length of time for the seismic job. To that those 2 years would be an additional 42 million in the pot, but what's the outlay, and trying to factor all that in. So I do appreciate this organization, this entity, this district always kind of looking ahead this way, because I think it really helps in terms of planning. And I could guarantee you that doesn't happen other places the same way. So I'm very grateful. Again, looking at my colleagues for any questions on this particular item.
I did forget one thing, that I did want to thank Eric on your staff and Jennifer Renucci behind me, who puts this together each time. So I want to make sure I get that out, because they will be here, and even if I'm not, and it will keep going.
We totally recognize it's a team effort and
Yes.
appreciate that. Director Cheerio.
This is great, but I do have a question with regard to the difference between this and how you did it just recently. And that is, there are no tiered projections here. Projections, that is, in terms of what it would be like if the commute remained as it is. What would it be like if the commute improved to what it was before the pandemic and so on? What was the decision between not including tiers this time?
The decision was to go back to what we used to always do. And that was not out of the blue. It was sort of looking at what we've been seeing the last couple of years and realizing that that we're sort of into a new, I wouldn't call it the normal, but we're into a new trend. They're very similar. The last 2 or 3 years are very similar. So we've gone back to sort of treating this agency like it had been for years, which is a very mature agency that continues to provide its services to a relatively normal level of population and demand. That's all we are. And also it's trying to make it a little bit simpler. It was more complex when we had those other things, but they are of value. And I think that those are good questions that the board can ask staff to do other work on those if and when you would like to see that.
Any other questions? One quick one from me, Joe, so I totally understand. I appreciate that second line that you added on page 36 with the based upon the actual spending. I also know that reserves and capital costs sometimes, obviously it's lower, because if we operate at today's level, there's less the asset management to replace. But at the same time, percentage wise, that's true. It's not true across the board though, right? I mean, there's certain things that you own that may not be, as long as you own them, you need to do the upkeep. Obviously that's true of the bridge. That really does reflect bus and ferry. Is that
Yeah,
what we're looking at there?
it reflects your service levels, and in the budget that we passed, there was less than previous years, but we did add some resources to allow growth to occur in case demand was coming back. And of course, since we're not spending those now, they are not into your current service level. So the bulk of that savings is an operating savings. The difference there, and it's just operating at the level you are at today. So I'm not saying it's any more realistic than what we put in the budget. It's another way of looking at it. You can look at sort of boundaries. Either we can do what we're doing now, not expecting it to drop, or we can have the one in the budget where we expected it to grow a little bit. And as we know, when you grow transit service, you lose money because it's a money losing business. And you need to get that money from someplace. And usually you get it from tolls and typically here at the district, you do that. So when you take that transit service out, or you take that expanded service out, you have less of a deficit.
So what
way
we
the
know
finances
is it's not
work.
going to be, at the end of the day, it's not going to be these numbers, but it's going to be somewhere in between.
It
And
is-
these are our kind of our
it is
bookends,
very-
guardrails, and everything else. So I
Absolutely.
do appreciate that. I just wanted to
Absolutely.
make sure I was.
It's just to
really
give you an
clear.
idea, because I want people to understand that where we are, by adding that second row, it meant to say the most is sort of, we had spent a lot of time over the last year looking at the $220 million figure saying, hey, we've got to cut that deficit back. We've got to cut that down. Well, that deficit was based also on a current services level. So this number is in alignment with that one.
Great, thank you. Again, anyone have any, before we take a motion and second, is there anyone from the public who'd like to speak on this particular item?
We have no speakers on this item.
Okay, with that, Motion to receive the updated 5 and 10-year financial projection.
So moved.
Motion and a second. We'll do a voice vote on this one. All those in favor, please say aye.
Aye.
Is there anyone opposed? Please say no. Hearing no opposition, that does pass unanimously. Thank you, and thank you, Joe. And you're going to stay there because now you're going to roll through the next 3 items, which staff's report of the 24-25 budget.
Would you like me to just do them in a row?
Yes, please. And
I will do
public
that.
Comment on all 3.
Sure, I will be happy to comment on all 3. So if we can turn to page, I think it's 55. And we did make a few changes to this table, so I just want to point that out. This is your status report on the budget that's going on right now. We're only 2 months into the year, so of course, there's not a ton of information on page 55. But what we did is this is sort of to monitor the deficit that we have now. And that we put into the budget to make sure that, of course, we're all working on it. You know that your staff is working on it and the public is aware of it. So on the top right-hand corner is the actual deficit that was in the budget, 36 million. That's that negative number at the top. And then we've added to this, changed around the lines a little bit. First thing we talk about is increased revenue. So or possibly increased revenues. In this case, they're not increased. But the idea is over the year, we might be able to increase our revenues, right? The first 2 months, as Dennis mentioned earlier to the Transportation Committee meeting, tolls have not been higher than we expected. And they have been the last couple of years, each month. This first 2 months, they haven't. That does not mean that the next ones will be different. Summer is always a little unusual here at the district. So there's actually, that has a negative impact on the deficit, actually raised the deficit a little bit. And the next one is other operating revenues. That has a substantially positive impact on the deficit. However, as I will mention later, a lot of that money is what the PFM representative mentioned to you. It's a higher portfolio value, which is paper, because we don't actually sell those bonds. We get the coupons off them. So it's paper income, but it does look good on the books. So that's lowering the deficit. And then, of course, the bottom line 3 is the one that says reduced expenses. And the expenses are lower than we're not spending the money yet that we put into the budget. And unless demand comes back, we won't be spending this money because your entire crew knows this is important. They keep the expenses down as we go through this part. So that's a positive change by $8 million. And that lowers the estimated use of your district reserves, which is line 4 at the very bottom, to 21 million. So not the 36, full 36, but 21. And we'll keep monitoring this each month. If there's no questions otherwise I'll move on to the next one.
Not seeing any money. Go ahead.
Okay, so if we turn down to page 65 and the table on page 65, and all I was really going to point out there was what Dennis already pointed out to the Transportation Committee meetings. If on the right-hand side, there are 3 boxes, one for bridge, one for bus, one for ferry. They provide data on your bridge traffic and also on your ridership. And as you can see, there's 5 rows of numbers there, and the fourth from the left, the one those are the actuals. And it says that the first 2 months were 1% down, 2% down, and then 1% down. And that's the first time we've seen that in back-to-back months since COVID, basically, since March and April of, way back in 2020. So it's unusual, but it's also summer. So I wouldn't, if we see this in October, November, then we can talk about there being maybe a new trend, but I don't know if we will. There's a good chance we won't. And then bus is, if you go down to that same row, just follow that column down and to the bus box, it's 6% growth and 0% growth, and that for an average of 3. And that's, really good, except for the last 4 years. It would have been great any other time in our history to see 3% growth. So, but it's a little lower than normal. And then ferry, the same thing. It's at 6%, and ferry was spent the whole last couple of years at 20%. Each time. So it's lower too. But again, summer. So we'll see how that works out. I will skip over the graphs that come next, and we'll go on to the financials, which are on page 71. And I'll take your attention to the page, to the table on the front of 71. After this table, of course, is the line item detail. If you have any questions on that, we can talk about that, but I won't point to that. But the table on the front, the far right-hand column is your current year-to-date revenues and expenses. And revenues are considerably over expenses right now. The biggest boost there, of course, is this, what I call paper money, this ride in your portfolio. And you will continue to see that if the Fed is correct and they are able to, without causing any damage to the rest of the economy, they're able to continue lowering the rates. That will continue to boost the portfolio value. And when you have $450 million in the bank, a small boost in that value is a big number. And in our, when it comes into our budget. So it's 6 million already through the first 2 months. And that's, as I said, it's paper money. We won't actually get that money. But if you had to liquidate, then you would, but we're not intending to do that. This money is to repair all those assets we've been talking about over the next decade to do that. So, but on the other hand, even if you take that out, there's still a very positive story here. Through the first 2 months, we're about 6 million, 7 million up on revenues over expenses. These are, of course, our best revenue months, our highest revenue months. They tend to be some of our lower expenditure months for a strange sort of anomaly that happens in the beginning of the fiscal year, which was, of course, July. That month tends to be low, but in general, that's all a good sign. And that just tells you that our business is still there and our crew is still keeping their expenses down. So those two things are very good. So it's a positive picture overall, just not quite as positive as it looks. The same story goes for capital, which is on page 81. The first 2 months, they're spending pretty much right on target. With that, I'm open to any question on any of those reports.
Great, thank you, Joe. Looking to my colleagues. Just want to say thank you to not just you, but everyone for maintaining that fiscal discipline.
Yeah.
I really do appreciate that. Just helps out across the board where we're at, and it's been great. Curious about, you guys are the experts in terms of the definition of a trend, how you take the seasonal issues into it. I know even weather could be part of that, and I know it's kind of looking at the longer term. I guess we're always better off the more years we have from COVID to try to figure that out, and we'll settle into a pattern when we should start to really worry about the numbers as they roll out month over month.
Because we have so much variation in the summer, number of weekend days in a month, during weekdays, the weather, there are a number of different things that can happen, and we get a lot of seasonal activity from visitors and other things. So it's just more difficult to look at a summer month and say, oh, that's the beginning of a trend. We just know that from looking at these data for decades. So that's good. That's why I say if you get into this sort of when things calm down in the October-November timeframe, if we're looking at lower October-November numbers than we saw last year, I think that definitely is a trend. I mean, I could be wrong, but I would assume it. So we'll talk about that if we see that. But somehow I'm not expecting us to see that, but I'm expecting to see back to it being at least level or maybe a little up, but we'll have to see. At some point, it can't keep just walking up. It's that old adage that if you're like we do the projections, you can't just pretend that there's going to be a 3% increase today and that'll go on for 10 years. Things don't work that way. And in our case, there won't be a little bit of growth forever because at some point you get to an unrealistic number. So we know it goes up and down, and that's been our history. We have usually small growths for 4 or 5 years, and we have some flat, maybe some down for 2 or 3 years, and it kind of grows up. What we've been really fortunate over the years for the district is we don't have huge economic shocks. Before, of course, we got to the pandemic, we didn't have huge economic shocks. Even when there's a recession, we tend to be pretty recession-proof.
Appreciate that. Again, looking to my colleagues for any questions, comments, concerns in this. These are informational.
Yeah, just these last 3 years of are the highest in of ever recorded. We're on a trend for hotter and hotter summers and storms and things like that. So just a comment.
Appreciate that. If there's no more questions of Joe, do we ask for public comment on these items 9, 10, 11?
We have no public comment on all these items.
Perfect. And do we have public comment at all for item number 12?
Staff on the line, no public comment.
Okay. With that, I'll look to my colleagues for a motion to adjourn.
So move.
Hearing no opposition, we are adjourned.